Back with Talking Point right here on NETV Profit. The stock of the day, or probably for the week, has to be ITC. Maybe for technical reasons, but let's enlist those at least. Mahima, my colleague Johnson, to talk about the same. Mahima, good morning.
Good morning, Neeraj. So as you rightly mentioned, it is clearly the stock of the day. It did touch an intraday high of almost 8.3%. So the supply overhang that we were talking about is clearly not there. The demand is there. Well, a lot of brokerages came in and have given their view on this. Nuvama talks about how it will impact the passive flows. They expect around 538 crores of inflow in Nifty 50 and around 315 crores in terms of Sensex. Now, they do not anticipate any weight increase in the global passive funds per se. Now, there was also a Morgan Stanley note on ITC where they have rated ITC as overweight with a target price of 491, and they believe that the stake sale will clear the uncertainty around the stock performance, and they expect ITC stock to outperform. They remain bullish on ITC based on moderate cigarette tax environment, continued scale up of non-cigarette business, and the reasonable valuations that ITC has at present. There was also an HSBC note where HSBC has upgraded ITC to buy with a target price of 480. They've said that ITC stock price has corrected from its peak and it's down around 11% YTD, and this implies an attractive valuation for its cigarette business as well, and it creates a buying opportunity for sure for the even if the taxation overhang persists. They think that there is no volume growth, but the cigarette business will structurally will range from 5 to 6%. So this is what the brokerages are also making out of ITC.
Thanks to that, Mahima. Rajesh, consumers, staples in particular, have had a bit of lackluster performance the last few quarters, if you will, save for maybe ITC, which has maybe had a good run and then now lumbered over the last 1 year. What do you do with staples?
I think we spoke about it the last time as well. I think the recovery in the staples and overall consumption space minus high-end discretionary seems to be very, very weak and elusive. The recovery seems to be quite elusive, and we're not able to see that recovery. And it confounds us that 1.4 billion people are not seeing the same type of recovery in consumption. Be that as it may, I think it's very difficult to preemptively call this recovery because we've been trying to do that for the last couple of years. Neither do the valuations of these companies give us any comfort that, look, there's an option value in case the recovery does take place, and then the upside is really very, very big if that happens. So neither are the valuations that comfortable. And as far as a fund manager, what I can tell you is I'm finding so many other sectors, right? So whether it is general insurance, life insurance, telecommunications, domestic pharma, global pharma, power sector, where I can see multi-year visibility of growth, right? So fortunately, I am able to create a fairly diversified portfolio of multi-year growth opportunity companies, strong companies within all of these sectors. So to that extent, my temptation to preempt a consumption curve is quite low.